Picture this, a trading floor gone silent. Screens that usually pulse with green and red numbers are frozen. Traders huddle in small groups, phones pressed to their ears, faces tight with worry. You don't need to be there to feel it, you've seen it in headlines, in your portfolio, in the pit of your stomach when markets plunge. Here's the surprising truth, crashes aren't just about numbers. They're about people. Fear, hope, memory, and momentum drive markets more than equations. A market is a crowd of minds, not a machine. When those minds sink in panic, prices fall faster than any algorithm can explain. Think about what flashes in your mind when you hear market crash. A red arrow pointing down? A sudden bankruptcy? A geopolitical shock? Those are triggers. The deeper story is how people react. Panic spreads. Confidence evaporates. What makes sense for one investor, selling to protect themselves, becomes dangerous when millions do it at once. Imagine waking up to see your retirement account down 20% overnight. Instinct says, act fast, sell, escape. Multiply that instinct across millions, and you have the anatomy of a crash. It's not just supply and demand, it's the psychology of fear and the contagious nature of human behavior. In a few minutes, we'll pull back the curtain. We'll explore the psychology that turns ordinary selling into a cascade. You'll meet the mental shortcuts investors use. You'll see how stories, narratives we tell ourselves, shape markets. And you'll learn practical ways to spot warning signs before panic becomes a stampede. By the end of this video, you'll understand why crashes feel inevitable in the moment, and how they really start with human minds, not just bad news. Markets have always been social systems. Long before electronic trading, people gathered in marketplaces, watching each other's behavior. Prices reflected not just supply and demand but also expectations of what others would do next. That social element hasn't disappeared, it's just faster now. History shows repeating patterns. Tulip mania in the 1630s, fortunes spent on bulbs because people believed prices would keep rising. The South Sea bubble and Mississippi bubble in the 18th century, compelling stories, easy credit, and a rush of buyers. The 1929 crash, the dot-com bust, the 2008 financial crisis, different triggers, same psychological mechanics. Behavioral science gives us the foundation. Heuristics, mental shortcuts, help us decide quickly but can mislead. The availability heuristic makes recent events feel more likely. See a bank fail, and you overestimate the chance of more failures. The representativeness heuristic makes us see patterns where none exist, assuming a rising stock is a sure winner because it looks like success. Social proof is another driver. We look to others when uncertain. If everyone buys, we assume they know something. If everyone sells, we assume danger. Social proof amplifies trends, turning cautious moves into collective momentum. Then there's loss aversion. Losses hurt more than gains feel good. That urgency accelerates selling in downturns. Add feedback loops, price drops cause selling, which causes more drops, and you have the mechanics of a crash. Technology and media amplify these forces. News spreads instantly. Social media magnifies narratives. Trading apps make buying and selling frictionless. That lowers barriers to action and raises the chance of mass reaction. Finally, remember, markets are forward-looking. They price expectations. Shocks force updates, but updates are messy. People anchor to past prices, cling to stories, and disagree about the future. That messiness is where psychology matters most. Now that we've set the stage with history and context, let's really dig into the psychology behind market crashes. This is where things get fascinating, because once you understand the mental forces at play, you start to see crashes not as random disasters, but as predictable outcomes of human behavior under stress. 1. Herding and contagion. Humans are social creatures. We look to others for cues, especially in uncertain situations. In markets, this instinct becomes herding. If you see a crowd rushing for the exit, your brain screams, follow them. It feels safer to move with the group than to stand alone. In finance, herding can be rational. If you don't have perfect information, copying others might seem like the best bet. But when everyone copies, the crowd itself becomes the information. That's how contagion spreads. A rumor about a bank's weakness circulates. One investor sells. Others notice the price dip and sell too. Soon, the rumor becomes reality. The bank struggles because confidence evaporated. Social media supercharges this dynamic. A viral post, a trending hashtag, or a sudden flood of memes can spark thousands of trades in minutes. Think about the GameStop saga in 2021. It wasn't just about fundamentals, it was about collective action, amplified by online communities. Herding turned into a movement, and prices swung wildly. The lesson? Herding isn't just about fear. It's about belonging, identity, and the desire not to be left behind. In crashes, the desire accelerates panic. 2. Narrative economics. Numbers alone don't move people. Stories do. Nobel laureate Robert Shiller coined the term narrative economics to describe how stories spread like viruses, shaping economic behavior. Narratives simplify complexity. They give meaning to events. And they stick in our minds. Take the dot-com bubble. The narrative was irresistible. The internet would change everything. Companies didn't need profits, they just needed eyeballs. Investors bought into the story, not the spreadsheets. When reality failed to match the narrative, the crash was brutal. Or consider 2008. The narrative was that housing was safe, mortgages were innovative, and risk was dispersed. That story collapsed when defaults rose. Once the counter-narrative, toxic assets, spread, trust vanished. Credit froze. Panic followed. Narratives matter because they shape expectations. If the dominant story is optimism, markets rise. If the story shifts to doom, markets fall. Crashes often begin when a prevailing narrative flips. And because stories spread socially, the shift can be sudden and contagious. 3. Overconfidence and risk misperception. Before crashes, confidence runs high. Investors believe they can outsmart the market. Risk feels manageable. Leverage looks safe. This overconfidence leads to crowded trades, many investors piling into the same positions. When those positions turn, exits are painful. Overconfidence also distorts perception. People underestimate downside risks and overestimate their ability to react in time. They assume they'll get out before it's too late. But in reality, liquidity dries up fast. Prices gap down. By the time you act, the damage is done. Think of the housing market before 2008. Investors believed home prices couldn't fall nationwide. That confidence fueled leverage and speculation. When reality intruded, the unwind was catastrophic. Overconfidence isn't just arrogance, it's a cognitive bias. We all tend to overrate our skills and underestimate randomness. 4. Feedback loops and market mechanics. Psychology doesn't operate in a vacuum, it interacts with market structures. That's where feedback loops come in. A small drop triggers selling. Selling pushes prices lower. Lower prices trigger more selling. The loop feeds itself. Mechanics amplify this. Margin calls force investors to liquidate. Stop-loss orders automatically sell when prices fall. Algorithms detect momentum and pile on. What begins as a modest decline can spiral into a crash. Consider the 1987 crash, known as Black Monday. Portfolio insurance strategies were designed to limit losses by selling futures as markets fell. But when everyone used the same strategy, selling cascaded. The feedback loop turned a downturn into a historic collapse. Feedback loops show how psychology and structure intertwine. Fear sparks selling. Structures magnify it. Together, they create cascades that feel unstoppable. 5. Memory, anchoring, and generational cycles. Memory shapes behavior. Investors scarred by past crashes may overreact to new downturns. Or they may underreact, believing this time is different. Anchoring plays a role too. If you bought a stock at $100, seeing it at $70 hurts. You anchor to $100, hoping for a rebound. That anchor delays selling or magnifies regret. Generational cycles matter. Those who lived through 1929 were cautious for decades. By the 1990s, that memory had faded and risk-taking surged. After 2008, caution returned. But as new generations enter markets, old lessons fade. The cycle repeats. Anchoring and memory explain why markets don't behave like pure math. They behave like human history, are messy, emotional, cyclical. Real-world examples. Let's ground this in specifics. Dot-com bubble, 1990s to 2000, narrative of tech revolution. Overconfidence soared. Herding pushed valuation sky high. When profits failed to appear, the unwind was brutal. 2008 financial crisis, narrative of housing innovation. Leverage hid risk. Defaults rose, trust collapsed. Fear and loss aversion drove rapid deleveraging. Panic spread globally. COVID-19 crash, March 2020, narrative of uncertainty. Herding amplified fear. Algorithms accelerated selling. Loss aversion drove exits. Policy intervention stabilized markets, but the psychology was clear: sudden shock, contagious panic. Each case shows the same mechanics: stories, confidence, herding, feedback loops, memory. Different triggers, same psychology. Why predictions fail? Analysts try to predict crashes. Sometimes they're right, often not. Why? Because human behavior is adaptive. A warning can be ignored until too late. Or a small shock triggers outsized reactions. Predicting exact timing is nearly impossible. Better than prediction is preparation. Think probabilistically. Build resilience. Recognize your own biases. Understand that crashes are part of the cycle. If you expect them, you're less likely to panic when they arrive. Institutions and policy. Central banks and regulators play a role. Circuit breakers halt trading to cool panic. Liquidity facilities reassure investors. Bailouts stabilize confidence. These tools change expectations. If you believe support exists, you're less likely to panic. But policy has limits. It can create moral hazard. If investors expect rescue, they may take bigger risks. And policy can't erase psychology. Fear, narratives, and herding still drive behavior. Institutions can dampen panic, but they can't eliminate it. The human element. At the core, crashes remind us that markets are human systems. They reflect our hopes, fears, and stories. They're not just charts, they're collective psychology in motion. That's why studying crashes is so valuable. It's not about predicting the next one. It's about understanding ourselves. Recognizing our biases. Seeing how crowds behave. And preparing to act with perspective when panic strikes. So what do we learn? Crashes aren't just math. They're human. Fear, stories, shortcuts, and crowd behavior drive them. Narratives matter. Pay attention to the stories dominating headlines. They shape expectations more than numbers. Loss aversion is powerful. Recognize your instinct to avoid pain. It can push you into rash decisions. Herding is contagious. When everyone moves the same way, ask yourself, is this information or just imitation? Feedback loops amplify shocks. Small triggers can spiral when psychology meets market mechanics. For you as an investor, the lesson is resilience. Don't try to predict exact crashes. Instead, prepare. Diversify. Manage risk. Know your own biases. Understand that markets are social systems, not just charts. And remember, crashes feel inevitable in the moment, but they're not random. They follow patterns rooted in psychology. By recognizing those patterns, you can stay calmer, act smarter and avoid being swept up in the stampede. The next time headlines scream for market crash, pause. Ask, what's the story? What's the crowd doing? What's my instinct, and is it driven by fear? That pause can make the difference between panic and perspective. Markets rise, markets fall. But the psychology behind crashes is timeless. Understanding it is your best defense. So when the next storm hits, you'll know it's not just numbers falling. It's human minds at work. And with that knowledge, you can stand steadier than the crowd.